The global foreign exchange market turns over more than $6.5 trillion every single day, making it the largest and most liquid financial market on the planet. And this morning, Monday the 13th of July, 2026, traders in London, Frankfurt, Tokyo, and New York are navigating a currency landscape shaped by shifting interest rate expectations, cautious central bank communication, and a risk appetite that has been anything but predictable over recent weeks. The London session opened at 8 o'clock this morning, and already the key currency pairs are showing movement that tells a very specific story about where global capital is flowing, and why. If you trade currencies for a living, invest in international assets, or simply want to understand how Forex dynamics affect your savings, your pension, and the price of goods on your supermarket shelves, you are in exactly the right place. Let us break down what is driving the currency markets today, what it means for your positions, and what you need to watch for the rest of this week. As the London session got underway this morning, the US dollar index, which measures the greenback against a basket of 6 major currencies including the euro, pound, and yen, was holding firm. The dollar's resilience has been a consistent theme throughout the middle of 2026, underpinned by a Federal Reserve that has remained notably cautious about cutting interest rates too quickly. With U.S. inflation still running above the Fed's 2% target on certain core measures, markets are pricing in a delayed and gradual rate cut cycle rather than the aggressive easing many had hoped for at the start of this year. Higher for longer U.S. interest rates mean higher returns on dollar-denominated assets, and that continues to attract capital flows into the greenback. The dollar index has held above a key technical support level for the third consecutive week, which is a meaningful signal for traders using momentum strategies. Any crack in that support level, particularly if triggered by a soft U.S. inflation print later this week, could spark a sharp, fast dollar sell-off across multiple pairs simultaneously. Let us focus on the British pound, because for many of our viewers here in the UK, sterling's performance has very direct real-world implications, from the cost of imported goods to the value of overseas investments. The Bank of England's Monetary Policy Committee has been walking a genuine tightrope in 2026. Headline inflation has eased considerably compared to the painful peak seen a few years ago, but services inflation, which tracks the cost of haircuts, restaurant meals, and professional services, has proven stubbornly persistent and remains uncomfortably above the bank's 2% target. This means Threadneedle Street has been reluctant to cut rates aggressively, which has actually provided sterling with a degree of support relative to currencies where central banks have moved more decisively to ease policy. On the technical side this morning, pound sterling to US dollar is approaching a level that chartists have been watching closely for several weeks. A decisive and sustained break above recent highs could open the door to further sterling gains, potentially targeting levels not seen since earlier this year. Conversely, a rejection at current levels would likely see the pair retrace sharply toward lower support zones, and traders should have clear stop levels in place. The euro has had a mixed start to this Monday session. Euro to US dollar has been caught in a tug-of-war between US dollar strength and uncertainty surrounding the European Central Bank's own rate outlook. The ECB began its rate-cutting cycle earlier and more decisively than the Federal Reserve, which has, in straightforward terms, weighed on the euro as interest rate differentials have widened in the dollar's favor. When you can earn a meaningfully higher yield on dollar deposits than on euro deposits, global capital tends to flow toward the dollar, and that is precisely what has been happening. However, signs of a stabilizing eurozone economy have prevented a sharper euro sell-off from materializing. Markets are watching German economic data particularly closely right now, as Germany, the Eurozone's largest economy and its industrial engine, has been the primary drag on the broader bloc. Any meaningful improvement in German industrial output or the closely watched IFO Business Climate Index could give the euro a short-term boost. For today's session specifically, there are no major Eurozone data releases scheduled, meaning euro to US dollar is likely to take its cue from broader US dollar sentiment and any spontaneous commentary from ECB officials. Perhaps no currency story has been more compelling through 2026 than the Japanese yen. The Bank of Japan's gradual but deliberate shift away from its decade-long ultra-loose monetary policy stance has been one of the defining themes for global currency markets this year. For years, the yen was used as the primary funding currency in so-called carry trades, a strategy where investors borrow cheaply in yen to invest in higher-yielding assets elsewhere in the world, pocketing the interest rate difference as profit. As the BOJ moves to normalize policy and Japanese interest rates edge higher, those carry trades become less attractive and can unwind rapidly. This morning, US dollar to Japanese yen continues to reflect the tension between a still relatively hawkish Federal Reserve and a Bank of Japan that is moving carefully but decisively toward a more normal interest rate environment. The critical thing to understand is that carry trade unwinds can happen with extraordinary speed, as the markets demonstrated dramatically in August 2024, when a sudden yen rally triggered a global equity sell-off within hours. Traders are keeping a very close eye on any shift in Bank of Japan communication this week. Yen volatility remains elevated, and position sizing on JPY pairs is absolutely critical for managing risk appropriately. Beyond the major pairs, commodity-linked currencies are also telling an important story this Monday morning. The Australian dollar, the Canadian dollar, and the New Zealand dollar, often referred to collectively as commodity currencies, tend to perform well when global risk appetite is positive and commodity prices are firm. These are economies whose export revenues depend heavily on raw materials, iron ore and copper for Australia, crude oil for Canada, and agricultural exports for New Zealand. This morning, risk sentiment is cautiously optimistic. Major equity futures are pointing modestly higher, and crude oil prices have stabilized following a period of supply-side uncertainty. The Australian dollar has been a modest outperformer in recent sessions, supported by still elevated iron ore and copper prices and a Reserve Bank of Australia that has maintained rates at restrictive levels for longer than many analysts had anticipated at the start of this year. For traders looking for momentum-driven opportunities today, Australian dollar to US dollar and NZD/USD may present interesting technical setups, though it bears repeating that all commodity currency positions carry an additional layer of sensitivity to any sudden shift in global risk appetite, which can reverse quickly. From a technical analysis perspective, there are several critical price levels across major currency pairs that professional traders are watching closely as this week begins. On pound sterling to US dollar, the 1.2800 region has acted as both strong support and resistance across recent months, and any sustained, high-volume move above this level would represent a technically significant development and could attract momentum following buy orders. On euro to US dollar, a key zone around 1.0800 aligns with a longer-term moving average and a Fibonacci retracement level, making it a genuine battleground between buyers and sellers. On US dollar to Japanese yen, the 155.00 level remains both psychologically and technically significant. A move back toward this level would likely prompt increased commentary about potential Bank of Japan intervention, as Japanese authorities have historically become visibly uncomfortable when the yen weakens sharply against the dollar. For traders who use additional tools such as the Relative Strength Index or Bollinger Bands, several pairs are currently approaching conditions that have historically preceded notable directional moves. The Monday Open is always worth watching for initial directional bias, as institutional traders often set the tone for the week in the first 2 hours of the London session. Looking beyond today to the rest of this week, the Forex economic calendar is packed with potentially market-moving events that every currency trader needs to have firmly on their radar. U.S. Consumer Price Index inflation data is among the most significant scheduled releases. Any surprise to the upside or downside will have immediate and dramatic implications for Federal Reserve rate cut expectations and, by extension, the direction of the U.S. dollar against every major currency simultaneously. In the UK, the focus will be on any public speeches from Bank of England Monetary Policy Committee members, given the current sensitivity around the timeline for rate cuts and the persistent debate about UK services inflation. Retail sales figures and labour market data, if released this week, will be scrutinised for any sign that the UK consumer is weakening under the pressure of still elevated borrowing costs. Geopolitical developments also remain firmly on the radar. Currency markets are acutely sensitive to any escalation in global tensions, given the dollar and Swiss franc's traditional safe haven roles. Traders should also factor in that July typically brings thinner trading volumes as summer holidays reduce institutional participation, which can lead to sharper, faster, and less predictable price moves in both directions. So, to bring together today's complete Forex market picture on this Monday the 13th of July, 2026, the US dollar remains the central gravitational force in currency markets, underpinned by a cautious Federal Reserve and US economic data that continues to hold up better than many had forecast. The British pound is holding its ground but faces genuine domestic headwinds from persistent services inflation and a Bank of England that is in no rush to ease policy. The euro is range-bound and taking direction from US dollar flows. The Japanese yen remains the most volatile and tactically interesting major currency, as BOJ policy normalization continues to reshape global carry trade dynamics. Commodity currencies are reflecting cautious but real optimism about global growth. Whether you are an active day trader, a long-term currency investor, or simply someone who needs to exchange money for business or travel, understanding these dynamics gives you a meaningfully stronger position than the vast majority of people engaging with currency markets. Manage your risk, define your levels before you trade, and stay informed. We will be back with the next full market update very soon.